Most homeowners make one of these 5 mistakes and they don't realize it until it's too late. Today, we're gonna fix that. So these are the mistakes I see clients make all the time, and it can cost them thousands of dollars, or it can cost them their dream house. So I wanted to go through each point of these today. Number 1 is not getting pre-approved first. A lot of times homeowners will come in and they have a property in mind, but they're not pre-approved. So maybe they toured a property, they saw something online, they want to make an offer, but they don't know their numbers. They don't know if they're pre-approved yet. So this can cause a big problem because you don't know if there's other offers coming in. So if there's something that you like, you got to jump on it quickly. Also, by getting fully pre-approved, you're going to know exactly your numbers. Maybe this house is going to be out of budget or something that you're just not comfortable paying every single month. Maybe the terms of it are just not going to work. So it's important to know all of your numbers very clearly up front before making that offer. Also, there's a big difference between pre-approvals and pre-qualification. You see, most banks and online lenders and mortgage companies maybe call it a pre-approval, but they're really offering a pre-qualification. So let me explain the difference between the two. A pre-qualification is providing your information, basically giving your application information, residence, income, employment, assets, credit. And then from there, the mortgage company is making a decision and saying, based on what you have told us, we're going to issue a pre-qualification. You can go out and look at homes up to this value. The problem with the pre-qualification is that none of your documents are verified. So they're going based off of what you told them. So a couple issues that could pop up. Maybe the income that you told them is not the exact calculation of how mortgage companies have to calculate income. For example, if you get bonus income, overtime, commissions, those have to be averaged over a 2-year period. They cannot be declining. Or self-employed income. We're going to go off net income off the tax returns, not your gross receipts. For assets, maybe there's large deposits or cash deposits we can't use as part of the qualification. So there's many things that go into an actual pre-approval that we have to make sure that are fully vetted. And that's what you want. You don't want a pre-qualification, you want a full pre-approval. Having a full pre-approval really allows you a couple things that are a big advantage. Number 1 is that when you make offers, a lot of times you can close in a very short period of time because everything was fully vetted up front. In our firm, for example, we would offer a 7-day loan commitment with a 14-day closing. So this would allow you the best negotiating terms when submitting an offer. A big advantage to all the other pre-qualification letters out there. And number 2 is you're going to know fully your numbers and 100% that you qualify for this house. You're not going to have that fear of putting an offer in and, oh yes, is it going to go through? Is this all going to work out? There's no fear. You've been fully vetted and fully pre-approved up front. And mistake number 2 would be changing jobs or changing your employment in the process or throughout the process. Listen, if you have an upcoming job change, you have to communicate that with your lender. You have to let them know what is going on. Even if you're getting a promotion, if the way in which you get paid is different, that could totally derail how the lender calculates your income. Or, for example, if you're maybe employed and you're going self-employed in the same industry, you're going off on your own, that could be a potential issue. Or if you've changed from a W-2 to 1099. Or if there's changes within your business, maybe you're bringing a partner in or letting a partner go or buying somebody out. All of that has to be explained up front to the lender, because if it's done mid-process, it could totally derail your approval. Mistake number 3 would be taking out any new debt or getting inquiries on your credit report or changing around your current debt structure. Again, all of this will need to be communicated with your loan officer at and during your qualification process. You see, this is how it works. Lenders are now required to have credit reports that monitor your credit report. So once you're under contract, that credit report, the reason it's so expensive is that provides monitoring for the lender. So if you have any inquiries or major balance changes within your credit, your lender is going to find out. So you don't want to take on any new credit. Also, lenders are required to investigate inquiries. So let's just say you have an inquiry for Toyota. They're going to be like, okay, well, I don't see any debt on your credit report for Toyota, but I see an inquiry. And you'll have to attest if you took out a new car loan or not. So everything has to be on that credit. You're not going to be able to hide anything. The lender will find out. So you have to be very transparent about your credit. Also, you don't want to close any credit accounts. So let's just say you have an old credit card you haven't used in a while and you're like, you know what, I don't use it. Let me just close it. The problem, that could reduce your overall credit limits. And so it'll reduce your credit score. You don't want to tank your credit score right when you're getting under contract or during the process. And also when it comes to items on your credit report, you never want to take a cash advance or an unsecured line of credit and deposit it into your bank account. Because what's that going to do? It's going to increase your overall debt to income ratio because the new payment will now be calculated on your credit report. And that money that you just deposited into your account, lenders can't use it. They're going to have to back that out because they're going to have to get the last 60 days of bank accounts. And if there's a large deposit and it's unsecured, they will have to back it out. You cannot use it to buy a house. Mistake number 4, not comparing loan options. Listen, you always want to get a second opinion. If you have a quote from your bank or an online lender, it's always wise to get a second quote. We all the time look at these other options from other banks, and sometimes there's hidden charges, or sometimes a client will say, listen, wow, I got this great rate. And then you look through the loan estimate and the bank is charging them a 3% fee to get that rate. Thousands and thousands and thousands of dollars, and the client doesn't understand it. So it's very important to compare apples to apples, to compare loan options, rate, and cost, to make sure you're not getting overcharged. Also, sometimes banks and lenders have different options that might be better suited for you. For example, if you're a self-employed borrower and you go to the bank, maybe the bank says, listen, you're only pre-approved for $250,000 because we're going off of the net income of your tax returns. But maybe there are other options out there for entrepreneurs that other lenders have. For example, we have loans that can calculate income based off bank statements, not the tax returns. So potentially we could get you approved for a higher amount. So again, it's important to compare options between lenders. Also, there are loan options that you need to compare too. For example, FHA and conventional. So a lot of first-time home buyers believe they have to be in an FHA loan. But listen, if you have a good credit score, really the best first-time home buyer loan is a conventional loan, 3% down. FHA is 3.5%. Also conventional, that mortgage insurance that you have to pay every month, that PMI, will eventually go away. Versus FHA will stay on there for the life of your loan. And also the FHA charges a 1.75% fee they just roll into your loan. So it's a lot of money extra in cost on FHA versus conventional. So again, it's important to compare products as well. And on the other hand, if you have FHA, the great thing about FHA is that you can qualify for, a lot of times, for more. They're more flexible on debt to income ratios. They're more flexible on credit scores. So FHA is a great option, but it's always good to look at both. And mistake number 5 is not looking at your overall monthly costs. It's very important to make sure that the mortgage payment, including everything, tax, insurance, HOA, mortgage insurance, fits into your overall financial plan and that you're comfortable with it. When I'm sitting down with a client, we'll have this conversation. Before I tell them what they're approved for, I will ask them, what are you comfortable paying per month? Just out of curiosity. So sometimes a client's maybe approved for $4,500 payment, but they're really comfortable at $3,000 or $3,500 a month. So it's important to have those conversations to make sure that the mortgage is going to fit into your overall financial plan. And we can't ignore all the miscellaneous costs. You have insurance, which can vary greatly, especially in states like ours, Florida, where you have, roofing and hurricane shutters and all of these things that come into account when calculating the cost of your annual premium. And it could vary greatly from a policy at $3,000 a year to a policy at $8,000 a year. Same with taxes. In Florida, we have the homestead exemption where it keeps your taxes low. So if you're buying it from a property owner that has owned it for a long time, the property taxes are going to be skewed. They're going to be too low. That's how your mortgage will be based off year one, but moving on to the next year, it's going to reassess and go up. So you got to have those conversations so you can have the right expectation of what your final payment's going to be once those taxes reassess. And then, of course, making sure you're looking at those HOA dues. If you're buying in an HOA community, you want to understand if there's an HOA and a POA, if there's upfront costs or annual costs that you have to pay. So you're fully aware, and so you can make sure that all of these costs, monthly and otherwise, will fit into your overall financial plan. So if you want to avoid all of these costly mistakes, it's very important you talk to a qualified mortgage professional. Listen, if there's anything I can do, and if you'd like to speak with me, feel free to reach out. I hope this video was helpful. If you have any questions, please let me know. Thank you. God bless. Bye-bye.